afternoon and welcome. As you know, Unlock the Stock is designed for retail investors to gain access to corporate management and to get to know them and their companies better. This episode is sponsored by Easy Equities, the platform that helps you to grow and protect your wealth, invest in local and international shares, property, unit trusts, cryptos, bonds, and actively managed ETFs, plus get access to Easy Protect life insurance and easy credit lending to back your financial journal. We are pleased to welcome for the first time to Unlock the Stock Fortress, Stephen Brown, the CEO, and Ian Foster, the CFO, join us today, and will soon take you through their presentation. Unlock the Stock is only possible with our technology partner, Lumi Global. Please visit their site, lumiglobal.com, to learn more about their various online AGM and investor presentation solutions. Our hosts today, as always, are the Finance Ghost and Mark Tobin of Coffee Microcaps, who will lead the Q&A session. Before we start, just a few housekeeping notes, please. Stephen and Ian will take you through the presentation, which will be followed by the Q&A. You can post your questions by typing them into the Q&A box at the bottom of your screen. The event is being recorded and will be available on our Unlock the Stock YouTube channel soon, together with about 40 other videos, so please do take a look at that. You will see an email address when we begin the Q&A. If you'd like to be added to Fortress's distribution list, please send an email to that address. With that, Jonathan, please could you share the presentation? And Stephen, I'm ready for you to start. Thanks.
Thanks very much, Deborah. I'm joined here with our CFO, Ian Foster, and thanks very much to the Finance Ghost and to Mark for hosting us. I'm going to take you through a few of the highlights of Fortress and just a little bit of a brief introduction as to who we are and what we do. So Fortress is a listed real estate investment company. If you flick over to the next slide there, Jonathan, thanks. We've got about 50 billion rand of indirect and direct listed assets. So the direct portfolio of about 34 is overweight in logistics assets. And these are really big warehouses, most of which we've developed ourselves. So relatively new, high quality. We've also then got a retail portfolio. That retail portfolio is largely in the rural areas, and it's focused around transport nodes. So taxi ranks, bus ranks, things like that. For example, in the Johannesburg CBD, we've got one at the Noord Street taxi rank. In Bloemfontein, we've got one at the main bus rank in the center of town. And those are generally 10 to 20,000 square meters, often with a ShopRite or a Boxer, Anchor, Ackermans, Pep, etc. And about 80% what we call national tenants, so those big national brands that you'll recognize. So quite defensive, and actually it's proven to be a top performer. Also in the logistics space, we recently, about 5 years ago, embarked on a strategy to buy some logistics assets in Eastern Europe, and we've got about 250 million euros in warehouses also that we bought and developed in Eastern Europe. That's mostly in Poland and one in Romania. Part of our balance sheet is also a 16.2% holding. That's the percentage we have of the whole of a business called Nepi Rockcastle, which is it's headquartered in Amsterdam. It is listed on the JSE. It's one of the index constituents in the top 40 index. I think it's round about number 23, 24 in the top 40 in terms of market cap. It's a big company, about 100 billion market cap. We own 16.2% of that. And that's also focused on Eastern Europe. They're one of the biggest landlords in Eastern Europe, very successful business. They raised some capital last year. We did participate in that to the tune of 100 million euros. They raised 300 million euros in an accelerated book build, which is quite amazing, oversubscribed, to buy additional Eastern European assets. In fact, that cash was used to buy 2 malls in Poland. And I think it's been a wonderful success story. And we've been very, very happy shareholders in Nepi Rockcastle, and we're happy to support them in that book build. So really, that's our focus, is logistics and retail, both here in Eastern Europe. The Eastern European retail, as I mentioned, we just do that through the listed vehicle of Nepi Rockcastle. They have a team. trading at a discount to NAV. We didn't think there was any point trying to compete with them, so we do that directly. And the logistics we do ourselves in those countries. And here in South Africa, we're one of the biggest logistics developers and logistics real estate owners in the country. Just in terms of our latest operational performance, I think real estate companies like to look at how the net operating income, so in other words, the gross rent less expenses, is growing over time. And when you look at the South African investment case for real estate, let's say you look at an asset at roughly 9% yield, that needs to grow at, in our case, about 5 or 6% to really get us a return above our cost of capital. If you look back through the slightly tougher years, about 5, 6 years ago, we weren't growing really above inflation, and I think that did hamper some of the outlook, and the assets got marked down a bit. But certainly in the listed space. But I think now you're seeing some pretty good numbers from us and from the other listed property companies. Balance sheet strength still pretty strong. We're just under 40% loan to value. That loan to value is measured. Ian will touch on that as our total debt over our total assets. Another part of our business is really selling the older assets and using that cash to develop new assets so that we don't need to knock on the door of shareholders for additional equity. And I think that's particularly important to preserve the value per share, that we aren't diluting shareholders. So we need to really change the mix of the portfolio, and we've been selling a lot of assets at a marginal premium to our book value, which I think just goes to almost prove our net asset value, and that's what I think the shares are worth, and we're trading at about a 25-30% discount to that. So if you look at our distributable earnings guidance, we're guiding about 160 cents of a dividend per share. That puts us on a clean yield of roughly 8.7%. I think the sector, I was reading some research this morning, the sector's at about 8.8, but there's a very important difference between our dividend yield and that which you get from the sector, which is predominantly REITs. I think in terms of the listed property sector, it's probably only us and NEPI that aren't REITs. So that 8.8 that you're getting from the sector is actually mostly taxable dividends. So a REIT, or a real estate investment trust, if you get a dividend from one of those companies, it gets fully included in your taxable income. Whereas if you get a dividend from Fortress, it's like a dividend from Standard Bank or Anglo, there's some dividend withholding tax, but you get it then a post-tax dividend. That's certain, and obviously if you're investing through an investment company, South African South African income tax will disregard that dividend withholding tax. There's no withholding tax between Fortress paying a dividend and another South African company. So I think it's certainly a more attractive yield if you are a tax sensitive investor. If you can flip over there, Jonathan. So this is really how we look at the end of December. It's currently how we look. Our two core focus areas are Fortress Logistics and Fortress Retail. Many years ago, we had a bit of a mixed bag of assets, and we looked at what was an attractive sector and where our core competencies lay, and that was really in logistics and logistics development, and retail in terms of commuter and township rural retail. So we decided to stick with those two and to cut off really the tail of our assets, being the offices and the industrial. So we've been using those proceeds from the sales to roll out our pipeline. And when you wind back, if you look at those bar charts on your screen about 5 years, it's quite a nice assessment to see, well, how have we done? Have we been able to sell and develop? We've developed 10.9 billion rand of assets in mostly the logistics space since 2020. And that's been funded by asset disposals, if you look on the right, of 8.4 billion. And that's been at a marginal premium to our book value. So I think we've proven that this is a sound strategy. We've proven that we're able to do it. And so we need to sell roughly 3.4 billion of non-core in order to fund the remainder of our pipeline, which is about 2.9 billion to come. And that's mostly in the logistics space. So I think it's something that we can do. And what happens over time is our portfolio gets so much better. We've got newer assets, better quality, better growth prospects. So I think that's, we're starting to see that really pay off in our like-for-like growth. If you can flip over there, Jonathan. So this is our target asset base. This is really what we're seeking to achieve over the medium term, which is logistics and retail, and then we also have the Napier Rockcastle shares. And I think if you look at, for example, the US, which has a very, very big market and a huge listed real estate market, they also have REITs. If you look there over the last 2 decades, that we've really seen massive specialization in that market. They have the telco REITs, which just do really the cell towers. They've got cold storage REITs, logistics REITs like Prologis, which is a company that we follow closely, Simon, who focuses on retail. What they did away with was these big diversified REITs. And I think we can see that strategy working for us, where you are focused and really a differentiator in that market, and you've got huge competencies. I think you're attractive to the tenants, and you have teams that are really adding value in that space. I think we've shied away from trying to be more diversified. In other words, having too many strategies. We're getting rid of the offices, getting rid of the old industrial. We haven't done any hotels or student accommodation, residential, things like that. And I think that focus and specialization certainly leads to better shareholder returns over time. If you can flip over there. So this is just our vacancies, which I think is a statistic that is very understandable for all market participants. And as you can see, vacancy has come down over the last several years. In our core portfolios, being logistics, SA, and Central and Eastern Europe, as well as retail, vacancies are really, really low. I'd say you almost can't expect them to go lower. You actually don't want a 0% vacancy. It means that you probably aren't asking enough in terms of rental. And retail, because of the refurbishments and moving tenants around, you sit usually at a structural vacancy of between 1% and 2%. We very rarely get down to 0. The offices in the industrial, we've lived with quite a high vacancy. Offices, strangely enough, are often easier to sell when they're vacant. We've sold a few offices in the last year, which have been to residential conversion specialists. And because we've been, I think, appropriate, we've been pretty hard on ourselves with the valuation, but that's enabled us to sell at our book values to specialist companies who take our offices and convert them to residential. And I think they have quite a lot of success with doing that. It's not something we're interested in. The industrial actually has been performing well. Lots of the same metrics that drive the logistics has been driving the industrial. And we've seen some pretty good like-for-like growth there. If you can flip to the next slide. So this again is our asset recycling. If we look forward, we've got about 1.4 billion rand per year to dispose of. And then we've got around about 2.9 billion in total, 1.2 billion a year in our pipeline. So that's how we plan to fund the pipeline. Added to that, we do have an option just north of our Eastport site, and I'll show you a picture of that one. Can you flip the next slide? So I'll hand over to Ian. He'll take you through some of the more complicated financials.
Thanks, Steve. Thanks, everybody, for joining. Yeah, so as Steve mentioned, that portfolio, and as a property company, what's important to us is that of paying a dividend and calculating and delivering distributable earnings to our shareholders. So for the 6 months ended 31 December, which is we pay a biannual dividend based on each 6-month period. That distributable earnings will be paid to our shareholders now, in fact, in the next sort of 3 weeks. And we'll touch on the options that we've given to shareholders. But on a per share basis, that 8.6% yield translates into 76 cents per share, a total distributable earnings out of the portfolio of roughly 900 million or 920 million. We did touch on just some key metrics on the slide. The LTV of the business, obviously, as a property company, debt is important. It needs to work for us, and we sit with an LTV of just under 40%, a very comfortable place for a property company. If we could just shift to the next slide, please. So coming back to that 920 million, where it comes from is the NOI, or the net property income. That's rental, etc., less costs of 1.3 billion. That number is important to us because it's got a stepped increase year on year, which really is delivered from the developments that Steve's already sort of alluded to. And I think you'll see a couple of slides of some of our new big box logistics that we're busy developing. That distributable earnings roughly up 12% for the equivalent period year on year. We add to that the dividend that we actually receive from Nepi Rockcastle. We don't follow exactly the same sort of methodology in determining our distributable earnings to that of the sector. We've drawn from the sector's principles in how we calculate distributable earnings, but we focus on exactly what is sort of cash backed and received in the period. So if you take the NOR from the buildings, add to that the dividend we receive from Nepi Rockcastle, we deduct the fund overheads, and then of course the interest costs attached to our debt. We've got some tax to pay because we're not a REIT, as Steve mentioned, and we deliver to our shareholders a post-tax distributable earnings of 920 million. We can flick to the next slide. Again, as we mentioned, we have had well, take a step back. We had a scheme of arrangement in February last year. We had a pretty complex capital structure which required a scheme to sort out, and that was in February last year. So we have had to show a pro forma position of what our earnings would have been should we have backed out the effects of that scheme from the prior year, which given all that development and the growth in the portfolio earnings that we've seen, we can see that the sort of distributable earnings on a per share basis, on a pro forma basis, would have been up circa 30% year on year. We offer to our shareholders, this isn't a sort of a standing arrangement, but we do every 6 months consider the position, and we'll offer to our shareholders either a dividend in cash. In this 6-month period, we've given shareholders the option to take up a dividend in cash or a share in Nepi Rockcastle on a ratio of 0.0069 per every Fortress share. And what that means, if we can just flick over to the next slide, we've got a quick example of what it would mean for an individual that was invested in Fortress. As we've mentioned, this is a post-tax dividend or dividend cash dividend. If you assume the shareholder to hold 1,000 shares would be 761 rand. If you were to take up the Nepi option, and this is again on a post-tax basis, it would be about 906 rand. And the strategy here is that we're focusing on a sort of a total shareholder return with a value unlock element, which we can do because we have these Nepis at our disposal. We can just flick to the next slide. So again, in the property company, one focuses on what the properties will deliver and the yield that the portfolio will give. This is really, there's a lot of detail in the slide, but if we can just focus on the bottom sort of block in the red, adjusting for the scheme of arrangement that we had last year, sort of sorting out our historic capital structure, you can see with the development income that's coming through on a pro forma basis what the yield is, and our circa 160 cents forecast or penciled in for year ended 30 June 2025 would be about a 24% increase year on year. Thanks. And over to you.
Thanks, Ian. If you can flip over there, Jonathan. So this is just a summary of our retail portfolio, just over 10 billion. I think if you look at the bottom right-hand block, like for like NOI growth of 9.2, we would love to say that's likely to continue, but I think it's probably going to settle around about 5 or 6%, which is very comfortable for us. That means we have a retail portfolio yielding us roughly 9%, and that's growing at comfortably above inflation at about 6%. So I think if that can deliver us a 15% total return with a stable cap rate at the end, I think that's exactly what we're targeting. And we've also been quite disciplined with selling the underperforming retail. The picture there is Abakulusi Plaza in Vryheid, which we refurbed. It's got a ShopRite and a Boxer, and I think it's all performing very, very well. If you can flip to the next slide. That's a picture of Abakulusi, and this is exactly what we seek. If you look at the top right there, that's the bus and taxi rank, which it took us 10 years to extend this development because it goes over a small sloot, and we had to wait for a water use license from the national department, and that took us 10 years. So these things are quite hard to do. You need a lot of patience, but really this is a star in our portfolio. It's really performing very, very well. There is another center out of town, but that's really for the motorized market, slightly more middle income. And I think what we target is convenience around the public transport nodes and high national, very basic goods, which gives us a more defensive portfolio. If you can flip over. This is just the tenant exposure. As you can see, all the big nationals, mostly Shoprite, Checkers, Pet, Massmart, Foschini Group, Mr. Price, Pick n Pay, and Boxer. And I think that's really the core of our portfolio, of these value-focused type of retailers. If you can flip over. So this is something that we've been very, very focused on, our logistics portfolio, almost 16 billion. This is just the South African share. And I think what excites me about this is if you look at that top right-hand corner, building valuation just over 10,000. For a new box at the moment, a generic spec, depends what you build, but you're probably looking at about 14,000 Rand replacement cost. And there was a guy who was well known as the father of US REITs, a gentleman by the name of Sam Zell, and he wrote a fantastic book called Am I Being Too Subtle, which if you're interested in real estate, it's quite an interesting one to read. And his focus was on replacement cost, and I think it's a key metric that we often forget. We get very fixated on yield, but at the moment, our logistics portfolio that we've built is below replacement cost in its entirety. So it would cost us a lot more to replicate that portfolio at today's costs. And the spec is relatively the same. So what that's doing is we're starting to see positive reversions coming through on the logistics portfolio. And it may not sound like much, but even if we have a small positive reversion, if you look at a 10-year lease, what that means is often you'll sign a 6 or 7% escalation. That means on a compound basis, when you're renewing that's grown at 6 or 7% plus 1 or 2, if that's your reversion, which is quite incredible in this market. And that's come through in the last few years, really as a result of construction cost inflation. It just costs more to build. Steel prices have gone up. We've seen a massive spike in inflation 2 years ago, and inflation's, as you know, sticky to the upside. People don't tend to bring costs down. It stays flat for a few years rather than us seeing a decrease. So I think that's a plus in terms of the standing portfolio we have. If you can flip over. So these are the developments we're doing. We constantly doing developments. You can see the yield. That's an all-in yield, land, capitalized interest in the, we need to factor in our opportunity cost, professional fees, etc. And the ones that you see in Poland are based in euros. So I think it's quite healthy in terms of the pipeline. And as you can see, long leases, 10, 12 years, sometimes 5 on the smaller things. If you can flip over. So this is our Eastport Park. It's in Gauteng. It's actually in Ekurhuleni, just past the airport. On the right there is the Pick n Pay distribution center, which we developed. And actually on the left, where the cranes are, is Africa's largest data center being developed. I think when it's completed, in terms of the full 3 phases, that'll take about 1% of Eskom's power. So it's a big data center. We sold them the land. It was something that they wanted to develop themselves, but you can see the park beginning to take shape there, and we have another option to extend this park just to the north, which actually is to the right. If you can flip over there. This is Clarewood. It used to be the old race course down in KZN. It's actually not far from the old airport down south of Durban. It's about 10 kilometers from the port. Took us a long time to develop. We needed to do an environmental impact assessment, which we did. That took about 5 years. So it's such a great location. Durban is very starved of this sort of premium grade warehousing. Just to give you a sense of the scale, if you look at the Pick n Pay warehouse we showed is 160,000 square meters. A standard size rugby field is about 10,000 square meters. So in that building on the left, you can fit 2 rugby fields. In those 2 on the right, you can fit about 4. in that 1 second from the left, which is actually Sasol product, you can fit about 3 or 4 rugby fields. Just to give you a sense of the scale, in the Pick and Pay building, you can fit 16 full-size rugby fields, and in the whole land that it takes for something like that distribution center, there would be 36 full-size rugby fields, 360,000 square meters. This park, again, is very sought after, getting higher rentals in Durban because of the proximity to the port and the lack of stock. You can flip over there. Very briefly, our industrial portfolio, quite small, but really quite sought after. Generally smaller tenants renewing all the time, so you don't get these long leases. But if you look at the bottom right there, like for like NOI growth of 9.7, quite difficult for us to replicate. I think it is still a portfolio that we're looking to sell, and fortunately there's pretty good demand for these type of assets, as you can see, because of the rental growth. Very hard to replace these assets at 5,000 Rand a square. They're going to cost you almost as much as a new warehouse. So that's probably, I would say, 50% below replacement cost for a similar product today. If you can flip over. Part of our industrial portfolio, we did a joint venture with quite an exciting new business called InnoSpace. It's been around for about 5-6 years. They really take old industrial space, quite similar to the Sirius model. If any of you follow that, it's a listed business, predominantly based in Germany. And they're really taking all the industrial space and cutting it up into very small micro units, which you rent on a per unit basis, not a per square basis. And that's growing like really, really nicely. If you look at our growth, NOI growth of 20%, I think it's about 15% like for like. But it's a product that I think doesn't really exist. For us, we didn't want to do it. It becomes very operational for us. I think InnoSpace has got a slightly higher headcount than Fortress, but manage a portfolio about probably about 12-15% of the size. So it's a very operationally intensive business, but they've got the track record, they've got the systems, and I think they're able to just increase those rentals over and above industrial space that really wasn't fit for purpose anymore. If you can flip over. As I mentioned, Nepi Rockcastle, we've got about 16 billion in this business. Very, very strong growth in those Eastern European markets. Just a fun fact, when apartheid ended, roughly 1990, and communism fell in the Eastern Bloc, so Poland and Romania, 1989, 1990, roughly the same time, South Africa's economy was equivalent to Poland and Romania combined. I think Poland this year or in the next year or two will be roughly double South Africa's economy, and I think Romania about a quarter to 1/3 less. So, if you look over the last 30 years, Poland's had compound GDP growth second only to China, and it's been transformational in terms of what that economy's done. And I think also in terms of the confidence that gives investors and gives, the locals, where you've seen this very, very secure long-term growth. I mean, we always get asked about what about the war in Ukraine. Poland, I believe, has the biggest standing army currently in Europe, and they're spending the most as a percentage of GDP on arms. So it's really becoming the engine of growth and one of the powerhouses of the whole of the EU, not just of Eastern Europe. And we have an office in Warsaw. We have about 11 or 12 people there now, and we are looking to grow that 250 million euro logistics portfolio that we have, and we also have internal capabilities to develop there. So Nepi's had success there. We have had some success in the recent years. So I think it's an exciting part of the world, and we do like this Nepi investment. 32% loan to value, very, very liquid shares, very good management team, able to acquire assets. A couple of years ago, they bought Forum Gdansk from a business called Blackstone, a US private equity business, quite well known, one of the biggest private property owners in the market and generally seen as one of the best investors. They bought the asset up north in Gdansk for 250 million euros from Blackstone. They found so much fat on that asset, managed to increase the NOI in 6 months. That asset was revalued at a similar cap rate at 330 million euros. So they managed to increase the value by 80 million euros, convert that to rands, it's about 1.5 billion in 6 months. So quite an amazing management team there. If you could flip over. This is our Fortress Direct Logistics that I was speaking about. Development yields roughly 7 to 7.5. Slightly longer leases that we've got there, so 5 years. As you can see, very high quality buildings. Like for like growth, we're getting roughly euro inflation. It's a slightly different model to here. There's no contractual escalation. It just escalates per the contracted CPI every year. Upside to that is when CPI spikes, as we have seen, you get more income, and it avoids these over-rented situations where your escalation is above inflation for a long time. Next one. This is just a picture of our logistics park in Bydgoszcz. When we bought this, we had 2 buildings and a shell, and we've developed out quite a lot. At the back there is our latest development. This one's nearly completed. If you could flip over. Part of our business has become energy solutions with load shedding. We really focused heavily on providing stable, affordable power to our tenants. We've done that with a lot of photovoltaic installations, and it's been a fantastic return for us. When we look back, we get about a 20% return on our solar PV installations. That's what we've actually got. And we've combined that just with backups, not with batteries. We haven't quite found the batteries to be feasible just yet. Still a bit expensive, but it's coming, and some backup power actually driven by generators. But this is something that we heavily focused on. Next slide. These are our portfolio stats for those of you very interested in the detail. It's available on our website in all of our results presentations. As you can see, total GLA 3.4 million. We do have some JVs, so our shares are a little bit less than that. 32.8 billion as at the end of December. That's our completed buildings, and then land and developments about 1.6 billion of work in progress. Thank you.
Thanks, Stephen and Ian. Thanks for joining us. Good to have a new name here on the Unlock the Stock platform. And yeah, we've had a good few reads, and they're always kind of very interesting to hear. Maybe we might start kind of where you finished off on Poland and Romania there. I mean, you talked about the incredible GDP growth, since the fall of communism. But maybe, why logistics within that market? We've seen others who are, in the retail end of the European market, and maybe, we've seen a lot of activity by a few other REITs in, Spain, Portugal, Germany. You mentioned Cirrus there, so maybe touch on why the asset class of logistics, especially within that European market, and why, the European market, Eastern European market, as opposed to, UK or Western Europe more broadly, like what tips the scales in those two directions?
Sure. So I think, why Eastern Europe for us, we felt comfortable with those markets through our exposure with NEPI. It's also, we have a board seat there, we see what goes on. So I think we felt very comfortable with the jurisdictions. The differentiator versus Western Europe, the UK, the US, is you have these economies which are relatively small, but they're growing quickly. And what they haven't had coming out of communism is deep capital markets. And I think that is a differentiator with South Africa, where we probably lack in the GDP growth, but we actually have these very deep, sophisticated capital markets. Those capital markets have always been dominated by the West in terms of equity and in terms of debt. So I think if you go there with risk capital, you can actually be quite a significant player with not that much capital compared to the West, which is also lower growth, but they have these deep capital markets. So I think that's a bit of a differentiator between Eastern and Western Europe, the UK and the US. So we like that. We think retail and logistics has got a lot of growth going forward, just from fundamental shifts in the market, especially in Eastern Europe with the retail. There is no high street, so NEPI doesn't compete with the traditional high streets, for example, you'd have Oxford Street in London or Madison Avenue in New York. They didn't develop those over the communist times, and the malls have become, really the retail destination. The logistics is also grown by, I think there's a bit of nearshoring in Eastern Europe. So I think, as we've seen, Europe is becoming quite focused on Europe, less reliant on the US and China for outsourcing. So Poland and the East have got a much lower labor cost, much lower rental rates. So for European businesses looking to set up distribution hubs or factories, Eastern Europe's very attractive. So we like that in terms of the logistics, and e-commerce penetration is very, very low. And we think that will grow over time, again, adding to the logistics angle for us.
Stephen, Ian, thanks for joining, and to everyone, just keep those questions coming in my DMs. I've received a couple already, which is great. I enjoyed you making rugby field references. That's very traumatic for Mark. Very mean of you in St. Patrick's Day week, I suppose, but you got to do what you got to do. What I wanted to ask you was around this e-commerce demand. You've just touched on it now with Poland and relatively low penetration rates of e-commerce. If I look at South Africa compared to markets like the UK and Australia and those sort of places in terms of e-commerce penetration, it also seems quite low. So I would imagine that's driving demand over time for specifically logistics properties. And if I read some of the US REIT type stuff, I mean, obviously the logistics properties REITs are beating that drum hard of look at e-commerce, look at the fact that we're having a shift away from from retail property into logistics. I mean, is that a big part of the thesis for South Africa for you? Is that part of why you're actually rotating out of industrial and into logistics?
Yeah, there's certainly a factor. It's interesting when we look at the actual demand, it's coming from the traditional retailers. So the big grocery retailers, the fashion retailers, that's actually really the bulk of the demand, looking to enhance their warehousing space to enable them to offer more e-commerce, as opposed to, for example, Amazon or someone like that coming in and just taking up lots of space. So there is that increment, but that's really driven by the traditional bricks and mortar retailers looking to diversify. So there is definitely that. I think South Africa will structurally probably have slightly lower e-commerce penetration. And I think a lot of that last mile, which we've seen so popular in these very big developed cities like London and New York, our thesis is that last mile will be fulfilled by the retail centers. You're not going to go and build a 500 square meter warehouse next to a shopping center of 20,000 squares when Checkers has got a 3,500 square meter box. They're probably going to use that infrastructure to fulfill those last mile deliveries. So I think the convenience retail probably is a beneficiary of e-commerce. And then you need these big distribution hubs, which in South Africa is still Durban and Joburg, because of the port, and then Joburg being slightly more convenient for the whole country as well as into Africa. So I think we're playing it like, we're going to see the value of very convenient retail increase for retailers, and then they're going to need these bigger distribution centers in the key distribution hubs.
Stephen, you talked about the solar rollout, and we saw a lot of solar panels on a lot of the buildings that you highlighted in your presentation there. I just wanted to touch on, you're talking about the batteries, but maybe if we take on a step further from that again, we've seen one of your peers in the industry, Growth Point, they're wheeling energy now across the grid in Cape Town from a private supplier that's not Eskom. These logistics hubs, I mean, have huge amounts of roof space, but, a very low footprint in terms of energy usage for the building and themselves. Have you, explored that in terms of, on selling that energy, wheeling it across the grid as we, this disentangulation, if I can say that, of Eskom continues, but, further down the line of, selling it on to the retail customers, who are operating in your other buildings, or just directly selling it on to the municipalities, where you're based? Maybe I know it's a bit of an esoteric question, but it's kind of something that is, slowly evolving. And when you have such huge roof spaces with, a low energy usage actually in the space itself, maybe just talk to us on that.
Yeah, thanks, Mark. Absolutely. A typical warehouse will you use about 5% of the roof space. That's enough to supply the warehouse, unless it's temperature controlled. And we do have one freezer, which is an unbelievable solar system. It's just under 4 megawatts, and they use it, as much solar as we can produce, and it's pretty flat. So that gets us about a 40% return on that installation. But a typical warehouse, you're not using it Saturday and Sunday because most of it's used even by the office. The air conditioners, lighting is very minimal. And absolutely, if you can unlock the wheeling and the potential of that roof space in and around the urban metropoles, because that's where our warehousing is. It's just, Eastport's just near the airport. We've got lots of roof space near the residential areas and other high power users. So wheeling would make so much sense. And, we've got all the infrastructure to be able to do it. So can't wait. The stumbling block is the municipality. Cape Town, it seems to have gotten better there, but most of our stock is Durban and Ekurhuleni. And the problem is there's a lot of talk, positive talk in terms of wheeling. The action on the ground, though, is not there yet. We're finding it very difficult to wheel. For example, in Eastport, we have a data center next door, which is soon to come online. I think phase 1 will use 70 megawatts. So we can, they will take every electron we can produce, but because they're on a separate stand, we have to go through Ekurhuleni. In notional terms, even though we set up the infrastructure that we don't, and therein lies the problem. I think it's such a big revenue generator for the municipalities that we feel that there's a little bit of hesitation in terms of really getting going with the wheeling. And there's also a little bit of uncertainty in terms of the tariff and the cost that we will be charged with wheeling through the municipal infrastructure going forward. So, I mean, I think there's an opportunity, but that opportunity is really being blocked by the local government. And, we would be very keen to work with whomever to see if we can unlock that and get it working, because at the moment we almost have a wasted asset on this roof space.
I'd like to dig in a bit more into this difference between logistics property and industrial property. And I mean, my base level understanding is if you see that kind of big box warehouse and there's big trucks parked next to it, and it's probably near an airport, we're talking logistics. And industrial is more if you see a little garage door and an office next to it, it's probably industrial. That's probably a terrible oversimplification, but maybe isn't too far from the truth. I think one of the big differences, if I'm right, is also in the negotiation and terms of the leases, right? So typically these distribution centers are very long leases with very large tenants in terms of large names, as opposed to, I think you have more churn in your typical sort of industrial properties. So I just want to understand a little bit more around, that kind of thing. Is that a fair summary of some of the differences?
Yeah, it is. I think it came from, really the use. Were people using these for, production, maybe light industrial, and that really became industrial. It was all called industrial 10 years ago. And then I think you saw the likes of Prolo just being, well, this is actually logistics. It's something else. It's got a better flavor. And it's really the use that we differentiate the two. Over the last couple of years, though, the manufacturing and any light industrial in South Africa is almost gone. So even those old industrial properties are being used by logistics players who need some sort of cheap storage space, but we still kept it in industrial, and also the mini units we classify as industrial. I totally agree. It's a bit of a gray distinction. There's obviously a point at which there's almost no distinction, but clearly the industrial parks, the big box warehouses, that's what we call logistics. And then the smaller parks, a little bit of what InnoSpace does, almost becomes last mile logistics. They're still getting some big tenants who just need a 300 square meter storage space for a period of time, or maybe they've got some overflow, things like that. And smaller e-commerce players, such as the guys who run the Veldskoen business in Cape Town. They have their office and distribution center in one of our properties down there. So yeah, there's a definite gray zone, but that's how we try and distinguish the two.
And sorry, if I could just have a follow-up, Mark, and I'll give it back to you because it's on that topic. So is this why you see stuff like InnoSpace, or if you read You referenced Sirius Real Estate earlier. You know, they always talk about their platform. I think theirs is called BizSpace. I could be wrong. You know, it's almost because there's more churn in the leases that you actually need that capability to be having these lease negotiations almost as part of your ordinary course of business. Whereas in your logistics properties, you're doing it every 10 or 15 years, right?
Absolutely. So there's you know, in a space you can walk off the street, you can walk to the counter. There's a park manager. You can swipe your credit card and you can sign the lease and you can gain access to space if it's available. Very, very different to us, where we dealing with a 3 million rand a month rent check for 10 years. And, you know, it's a key operational asset for a big national or multinational tenant. So that, you know, it takes us much longer. That's what our processes are really set up for. Whereas these things are operational. Come in, swipe, there's a 5-page lease, whereas our lease is, you know, more like 105 pages. So you're totally right. It's a platform that a few years ago we thought, well, there is a market opportunity to do it. Do you want to, you know, build this internally yourself, or do you want to try and find someone to partner up with who's already built it? And we went with the latter.
Just a quick one for me, maybe we get Ian in here, so he earns a few rounds at this call. I know you touched on the yield, but maybe I missed it in the thing. But have you guys landed on a payout ratio of like kind of what comes in? Because, you know, we saw kind of before COVID, you know, a lot of the REITs, which Fortress was, you know, a few years ago, it's obviously changed designation now, but, you know, a lot of people were paying out, you know, 100% or very close to 100%. A lot of the REITs today are much more conservative now. I think they've learned their lesson from COVID. You know, it's more around that 80% kind of mark, you know, kind of give or take you know, a few outliers like storage, but even they've, you know, dialed it back from 100 to 95. So when you're looking at, you know, the payout now, I appreciate it's a dividend rather than a redistribution. Do you still think about it in those terms, or how do you think about payout?
No, we absolutely think of it in those terms. In fact, so the REIT sector has got something called the REIT best practice sort of guide as to how they calculate dividends, and they refer to well, it's amounts available for distribution or funds from operation. It's the REIT FFO. The rest of the sector calculate that number and they say, okay, against that, what is the percentage that we're going to pay out? And that's the payout ratio that you refer to, 85, 90%, etc. So Fortress has drawn from that sort of that calculation, but has taken a slightly different view on it and said, well, what in that calculation makes sense to us as a business, and which of those items on a principal basis will we include in our distributable earnings? So we calculate the FFO, disclose it to our shareholders and investors so that they can have an equivalent metric to measure us on. But to determine the distribution, we take that calculation and we take only those items that are cash backed and put them into the bucket that we prepare to distribute. So we don't look at it in I suppose in the same light as the REITs to say, you know, do we have a payout ratio of 100% of FFO or 80% of FFO? We are comfortable to distribute 100% of what we determine to be the distributable earnings drawn from FFO, but only those items that are cash backed. So there would never be a situation in which you'd be borrowing to fund the dividend. And the FFO calculation often lands you in that space where you're accruing certain earnings or you capitalizing the likes of interest on your developments to drive what the dividend is. If you're doing that, you're borrowing to pay out a dividend. We don't do that. So we're very comfortable, in other words, 100% payout ratio, but of the principles that we've applied in determining what the distribution is, you know, fully a sort of fully cash backed a dividend.
I'd like to dig into the retail portfolio with a question, and we'll still make sure we get to Nepi before the end of this because I've got a question in my DMs on that. But just on the retail side, if I heard you correctly earlier, you were talking about these typical sort of commuter properties like near taxi ranks, etc. So targeting very much working South Africans trying to get from somewhere to somewhere else. The other thing that I read about a lot in the local market is the sort of township adjacent shopping center, which feels like they're trying to catch the shift from informal into formal retail. So I just wanted to confirm that I'm kind of understanding those two things properly. And then part of that question, I mean, there's a bit of a death match underway right now between ShopRite and Boxer in that end of the market. I guess as landlords, that can only be good for you, right? I mean, that's what you want to see, is people fighting over the space that you are in.
Absolutely. I mean, it's great to have some tenants fighting over it. Fortunately, a lot of those exclusivities are going to start coming to an end. There was a bit of a difference with the exclusivities in the kind of the cities and then outlying areas, and those were allowed to run a little bit longer. It's great to have some competition, and I must say, when we look at that box of business, it's very, very strong in the markets in which we play, obviously, as is ShopRite, but it's nice to have those two anchors vying for space. Yeah, it's exactly that. We have kind of centered around where's the taxi traffic, where are the buses, where are people moving? Let's be close to that, so it's convenient for them to come into our center and pick up a few packets of groceries and some clothes and things like that. And I think you need to be dominant in your specific little catchment. You don't necessarily have to have the big gorilla of 50,000 square meters in a certain town. That often is a slightly different offering, which is more fashion focused. I think we more value fashion, and then your basics, your pharmacy, basic kids clothes, your groceries, cell phones, things like that. So our fashion offering is a little bit less, and it's very much focused on value fashion and the basics, but it's exactly that: township, rural areas, and then in and around the convenient public transport nodes.
Just a question on the whale and the logistics side. I think it was like 4.9 years, I think you had on the slide. That seems pretty low for, if I'm a ShopRite and I'm gonna run a massive DC out of this thing, and in 5 years' time, this lease is up. Is it just because that is the lease in force, but there's 2 5-year options tagged onto the back of it, but it doesn't get calculated into the whale? I'm just sort of like, the whale is actually the 5-year lease that they've signed out, but we all know they're probably going to take up their 2 5-year options after that. So in effect, it's a 15-year commitment, if I can say that.
So Mark, we tend not to see a lot of options on the logistics boxes sometimes, but it's not as prominent as it is in the retail. But in general, we would sign usually a 10-year lease. But if you think we've been doing this for a while, and all those leases, so if nothing moves, we would go down by a year every year, right? If we sign no new leases. So if you're signing 10-year new leases, the boxes we developed 5 years ago have now got 5 years to run. Sometimes we do sign a 5-year lease or a 7-year lease. I'd say in general we ask for 10. The big retailers want to really control that space, so they'll do, for example, Pick n Pay did 15 years. But we quite like the logistics parks, and then a generic box of, let's say, 20,000, 25,000 squares. We find that depth of tenant is much deeper, so you have more options, more choice. The one issue we have with big distribution centers, and we have done a few, is that they are quite specialized. And at the end of that lease, what do you do? What do you do with 160,000 square meters of space in 15 years' time? And that's something that we often discuss, and I think we always come back to, we like the generic space that's very, very premium. It's high grade, but we've got lots of tenants that can come in and out. As soon as we start looking at the balance sheet of a tenant and how much credit risk we're taking, then we sit down and we say, well, we're a real estate company. If you've got a great location and a great product and the rentals, at market, doesn't matter who the tenant is. There are another 5 tenants knocking on our door for all of our space in these logistics parks, and that's kind of how we look at it. I also think what's changed is, everybody used to be fixated on, can we get a longer lease expiry? Can we get a longer lease? And now what we're starting to see with construction costs and us being marginally on our standing portfolio, probably marginally under rented, is you actually don't mind a shorter lease because it gives you an opportunity to maybe get a little bit more rental, and we've actually just signed a lease now in a reasonable logistics node in Gauteng, and it's escalated for the year, and we've managed to bump it up another 7.5% and then sign a new 5-year lease. So I think that's a very positive market momentum that we're seeing. So if you have the right product, I think the lease expiry profile, it's nice, but it's not the be all and end all of your return.
Okay, thank you.
We've only got a couple of minutes left, and I definitely do want to talk NEPI, so let's do it now. I've got a good question in my DMs, and there's a broader question around NEPI. Just your strategy with that holding, you know, in terms of you guys supported the book build, but then you've also used their shares to solve the capital structure issues that were very well documented. That was a very interesting time in your life, and for the rest of us just watching what was going on, I suppose. You know, you've used them in lieu of a cash dividend. It's very interesting because on one hand, you're buying more NEPI, and on the other hand, you're kind of shifting it out the door to your investors. So where do you see the correct sort of strategic stake for you being in NEPI? You know, how do you really think about this then long term? I mean, recognizing how strong a fund it really is.
Yeah, I think in terms of supporting the book build, it was something that we had given them an indication quite a long time ago that, you know, we would be there as their largest shareholder, as a core shareholder. You know, we'll be there for the market, and I think we needed to follow through on that. So it's a bit more, I would say, tactical than strategic. Strategically, we really like NEPI, but we are trading at a discount to NAV. And if, you know, we do get asked quite a lot by our shareholders, you know, they like to hold it direct, some like to hold it through us. But we thought it was quite a neat solution in terms of really de-gearing the debt against our direct assets, what we would call the RUM, in terms of saying, well, you have an option to take some NEPI shares. There's a little bit of a value unlock there for the shareholders electing that. That lets us keep the cash, and it lets us reduce the debt against the direct portfolio, which I think just enhances our options down the line in terms of, you know, could we split this fund into retail and logistics and NEPI down the line in the medium to long term to, you know, to follow through on our strategy and what we've been telling the market, which is focused funds with a specialization do better over the long term. We're not there yet. I think it's a neat way of getting there. But, you know, like I said, we're giving it to our shareholders. So it's a very different decision if you're going to sell it to the market and take away an asset that we believe is below fair value and give it to a third party, as opposed to saying, we believe this is below fair value. As a shareholder, you own it already. Would you like some of that directly in your hands? That's the sort of corporate finance decision we make.
Okay, I don't have any further questions from my side. I might hand back to Deborah just to close this out here.
Thanks very much, Mark. And thank you to everybody who chose to spend time with us today for this session. A very special thank you, of course, to Stephen and Ian for making the time to support this retail investor platform and to engage with our investors. We hope you enjoyed the event, and if you'd like to listen to it again, a reminder, it'll be out on our YouTube channel soon, and we do encourage you to subscribe to that to see our latest videos. And our next session is on Thursday, the 10th of April, and will feature a regular to unlock the stock, which is CA&S, and we're looking forward to that again. And that's it from my side. Thank you, everyone.